Welcome back, traders. How to engage markets when I don't have an initial bias? That's the question we're going to tackle in today's ICT lecture. This is going to be his technical review from February 2nd. So we're going to go ahead and get started right away. So make sure you give this video a like and subscribe.
All right, so this is a daily chart on NASDAQ, okay? And I've toggled the little set button down here in the lower right-hand side. I kept toggling it until I saw the more exaggerated volume imbalances, like that's a volume imbalance. These are volume imbalances here. So wherever the most exaggerated ones are, by toggling that set, that's usually the one I'm going to go with, okay? So it's the easiest thing. In terms of rules, that doesn't mean I'm always going to go with that, but I'm using it for that purpose. So that way I can see where there's a volume imbalance and whatnot. So long term on the daily time frame, buy side is up here and sell side is here. And watch this guy, he's got his eye on you. And if you take a look at this suspension block here, that's what we drove up into today. And now admittedly, I didn't know how we were going to trade today. And I watched price meander around, for weeks and weeks looking at this daily chart, trying to figure out where I want to see it go. And the only thing I settled on coming out publicly and telling you was that we would take out the relative equal highs on the daily chart. Now, this is a continuous chart, so it doesn't show like the front month, March 2026. March 2026's highs in here, okay, they don't look exactly like this. So they came up and cleared the relative equal highs out on March delivery. This is continuous contract, so it's factoring in every time there's a new contract, it roll over, it starts calculating that price action. So it's always going to be somewhat skewed, okay? So the suspension block in here, it drew up into that. And the reasonable draw would be to try to see it get up into halfway. And now if it can get above halfway and trade outside of it, then I would anticipate this acting as an inversion fair value gap. This is the analysis part going forward. If it can do that, then I think it may want to challenge these relative equal highs. But as long as we stay below the consequent encroachment of this suspension block, then we're probably just going to hammer around inside the range to find that high and that low.
Price did mostly stay in the lower half and delivered a pretty big down day. Now, it may seem pretty amazing that ICT got that part correct, but remember, he wasn't sure which way it would actually go. He outlined both directions. He told you what he will be looking for if price goes above the suspension block as well as below. So at the start of this analysis, he was 50-50.
All right, NASDAQ, we are in the 1 hour time frame, still sticking with the continuous contract. That's that suspension block here, shown on the hourly chart. And the sell side's here, the buy side just annotated over here, but the same price level. You can see how we dropped down, took out this low and that low, with this run into an inefficiency, which you see right here. Okay, so buy side bounce, sell side inefficiency, deep discount relative to that low up to the high. It's traded down into that, and then we opened new week in here, trade up into the gap, traded lower, rally up, and here's where we at the price action at the time of this recording. 15-minute time frame, zoomed in. Okay, you can see the 1 hour gap down here. Look at the bodies respecting consequent encouragement, and then the market reaching up into this measure of buy side. And here is the new week opening gap and the high and low of it. You can see we just ripped right on through that. Had no intentions at all coming back to it, and just really difficult unless you were expecting higher prices right from the beginning at the opening bell or sooner and just stuck with it. Yeah, it was going to run right over top of you. All right, so now we are in the 1 minute time frame, and here is that new week opening gap with all of the eighths and quarters level on it. And then we had this gap up in here, positive bell sell side efficiency, trade down to an order block. And I'm going to transition over to a 1 minute chart on the March contract. But all these levels here and the salient points have basically been consumed with what I've shown on the continuous contract daily chart in these time frames. But now let's roll over into the March contract. So we're going to strip it down completely naked, and then we're going to add the first hour's trading. Okay, so that's kind of like the focus, if you will, of this lecture today. If there's ever a time when I don't know what side of the marketplace I want to focus on, in other words, I'm waiting for more information, submitting to the first half an hour of the opening range, looking for first percent fair value gap, looking for the market to consume 9:45 or 10 o'clock news. If I'm just really reluctant to do anything until the first hour's trading, then it's usually going to be as a result of a market that just completely rips off into one direction, basically today. Okay, so with that, I highlighted the low and the highest high inside the first hour's trading. So at 10:30, go back to 9:30, mark out the highest high and lowest low.
Okay, so we're now going to get into the main lesson of trading without an initial bias. Now, honestly, if you're not very experienced and you're not able to derive a higher time frame logical bias, then I would recommend not trading on this day. Just watch, paper trade, or turn the charts off entirely. Because even though you could get lucky and make some profit, by having a bias is so helpful and will give you a much higher win rate. Now, looking at this chart, if I didn't catch this initial opening range, I would not want to trade any of this sideways action. I see price retracing back to 25% of the range and then heading for equal highs, but most likely I would have gotten stopped out on this retracement. And then the rest of the day, it would just be sideways. But let's see how ICT would tackle this.
Okay. And by having that range, what you can do is you obviously have to grade it, because all of your key PD arrays are going to form around in close proximity to one of these gradient levels. And I want to take your attention up into the upper half. So here's that 50% level. Okay, so this first hour's range, the upper half, it's going to be sensitive if it's bullish. Okay, so then I'm going to focus on that, not worrying about the lower half. So now what I've done is zoomed in to the upper half. And I'm going to go back one more slide so you can see what I just did. This little area in here, I'm zooming in on that. Okay, that is just simply half, or the upper half, of the full 1 hour's range. So that way we're going to transition one slide at a time. Now we're looking at the gradient levels, the upper half of the first hour's range, zoomed in on the first hour's upper half of that range. That's all that is. Okay, now right away you can see there's a quadrant level here, there's a, or not a quadrant level, a gradient level here, gradient level here, gradient level here, and we trade almost to this high here, but then we break that low. So this is the next one it's going to trade to. Now in this level here, look just above it, there's a small little gap there, but there's a swing low right there on that level. So go past that to the left. What do you have? Inefficiency. Okay, so you can see right away that that is a valuable candidate, potential candidate for a high probability discount PD array in the form of a buy side imbalance, sell side inefficiency, or BISI. And the market trades down to consequent encroachment. Look at the bodies, staying in the upper half. The market rallies up, comes back down, touches the gradient level, rallies up, drops back down in, trades higher, and eventually takes out the buy side above these relative equal highs.
Pretty interesting how by taking half of the opening range and zooming in, we create another trading range. And by grading it in eighths, we can treat these like quadrant levels. This is what we mean when you hear that price is fractal. And by treating this as equilibrium, this will be the first fair value gap in discount. But let's say you enter here and you trail your stop up to below this fair value gap, then this retracement will come and stop you out. So still a pretty tough trading day.
So what I want to show you now is I'm going to take off that blue box and I want you to think about what you see here. You see right there. Market maker buy model. Zoomed in, original consolidation, first stage distribution, second stage distribution, down right into that discount buy side balance, sell side efficiency. Rallies up. There is a conversion fair value gap here. Extend that forward. You see that right in here. There's accumulation. Second stage reaccumulation, but in the upper half, from this high down to that low, it's still trading at equilibrium. It trades down into that and then rips higher, attacking that buy side. Notice the bodies here. See how they're all more or less converging around the same level? Disregard that wick. I just had that as the highest high at the time. Then I thought that they were going to run just these bodies here, and you'll see that I did some executions here. So we have a inversion fair value gap there, trades up. I was watching to see if it was going to use that. It did, went below it, changed the state of delivery, which are these three up closed candles. That's my bearish order block. It's the opening price right there. Trades up into it, hits it. Very quick market, hits it and pulls away. I end up getting in as it's pulling away from it. Got a little bit of slippage there. You can see the prices, by the way. And then I added more to it there, and then added to it again in here. And then once more when we were trading back up into it there, and it ultimately filled out right on the consequent encouragement level right there. Now notice at the bottom of the chart, this is not market replay. I didn't have a chance to record anything today. My attention was divided between what my puppies were doing, what my wife was talking to me about, and doing this as well. So the recording wasn't possible. And the idea of trading down into that level there, and then I wanted to see, does it repel price there? Do this inefficiency here on a 1 minute chart for March delivery. Get the consequent encouragement level, and you'll see it trades right to there. And my exit price is right to the tick on the consequent encouragement level. That's what that price is. So it's just simply a limit order. I did fancy dance it, trying to be cute with it, but I could have been snuffed and not allowed to get out of it, and then it would have completely reversed on me. So if that would have happened, you would have saw that, I would have been stopped out up here, which you've seen executions do that sometimes with me. And then I went long, and now I'm using the market maker buy model. So I went long here, and then rallied up, traded down, had to take a little bit of heat against the position. The original stop has to be below that low right there. So buying here, stop loss down there. It's a little, it's a little wider than you're probably used to, because you want like really, really small stop losses, and they're kind of hard to pull off right now with the level of volatility you have. Like lots of back and forth, sharing the previous candles ranges. It's a little bit more difficult. The point is going long in here, absorbing all that, and then waiting for it to rip above these bodies here. Okay, so that is this. You can see that's where my exit was there. So there's a little bit of practice today. This obviously, it was demo. I'm not trying to put anything in with real money until we get till next week. If it doesn't improve or really show me something outside the range, then I'll stay in demo for a little while longer. I'm not in any rush. I'm not trying to get out here and offer up donations to the markets that are seeking to take everybody's money from them right now. So that's what I have for today. Just the opening range. When the markets are running and they're one-sided, and I have to wait for 10 o'clock news or 9:45 news, or I just simply don't trust the direction, or I have a hard line bias on what I want to trade on, I'll just simply wait for the first hour's trading. And then once I drop the gradient levels on them from the highest high and lowest low of the first hour's range, if I'm bullish, and it certainly looked like it was trying to get to that consequent encouragement of that daily suspension block, that was a likely candidate to draw up to. So that was the reason why I used the idea of the upper half of the opening range gap. Not the opening range gap, the upper half of. And that was the reason why I used the upper half of the first hour's trading range. If the market was going to stop me out and go lower and go that below the lower half, or equilibrium, trade into the lower half of that first hour's range, then I would look for the lower quadrant and complete roll over to the low of the first hour's low of trading.
So this one was not bad, all business, no fluff. However, I don't think there was a clear concrete model here. I feel like a lot of things were left out. He basically showed you how he would do it, but it was demo, by the way, not real money. So even he was taking my advice on not trading when you don't have a bias. I really think you need a solid top-down analysis before deciding to engage the markets. So hopefully you got something out of this. Please give this video a like and subscribe for more ICT reviews. And until next time, safe trading.